If you're a high earner who's been maxing out your 401k every year, there's a good chance you're stopping about $30,000 short of what the IRS actually allows you to put in. Some 401k plans have the second limit that almost nobody talks about, and the room between those two numbers resets to zero every January 1st. Meaning, if you don't use it this year, it's lost and gone forever. You can't go back and fill it in. We've spent decades sitting across the table from successful families who are absolutely sure they've maxed out their retirement plans. This is the number that surprises them.
Educational content only, not personalized investment advice. All investing involves risk. Consult a qualified advisor. Apella Wealth. Full disclosures below. It's called the Mega Backdoor Roth 401k. And the reason you've probably never heard of it is that it hides between two different limits inside the same account. So here's the first limit, the one you probably know. It's the salary deferral limit, the hard dollar cap on what you can put into your 401k out of your paycheck. So when someone says, I'm maxing out, that's the number they mean. But there's a second limit most people never see. The total that can go into the plan from all sources combined, your money, your employer's match, everything. And that number is $72,000 this year. The space between what you've put in and that total limit, in some plans, you're allowed to fill it with additional after-tax contributions and then move those dollars into a Roth IRA where they can grow tax-free.
So let's put real numbers on it, because this is where I think it'll click for you. Say the total plan limit is $72,000, like Sam said earlier. You put in $30,000, which is your regular deferral plus any catch-up contributions, and your company matches $10,000. That's $40,000 that goes into the plan, which means there's $32,000 of room left. If your plan allows it, you could fill that room with after-tax dollars and then subsequently roll them over to a Roth IRA. So, if your original $30,000 was already going into the Roth 401k, you've just put $62,000 into a Roth tax-free environment in a single year. Not $30,000, $62,000. Now think about what that money would have been doing otherwise. For most people, the savers, beyond their 401k, it would have been put into a regular taxable account where you're paying tax on the interest, the dividends, the capital gains every single year for decades. That's the quiet cost nobody adds up. One quick thing before the catch. This channel shares conversations that usually happen only behind closed doors, not out in the open. If you'd rather hear about planning opportunities like this before they happen rather than after it's too late, subscribe to the channel.
Okay, so why doesn't everybody do this? There's two hurdles, and they're both about your employer's plan. Have nothing to do with you. Hurdle one. The plan document has to allow after-tax contributions, and not every plan does. This is written into the plan itself, and it's a yes or no answer. Hurdle two, discrimination testing. The Department of Labor doesn't want executives and owners stuffing the plan while rank and file employees aren't participating. So the plan has to pass testing every year. And in some companies, that testing limits how much high earners can actually put in.
Now, here's the part that trips people up, even when their plan clears both hurdles, because getting the after-tax money into the plan is only half the move. So, Sam, tell them a little bit about why.
So those after-tax dollars are sitting inside your 401k and are growing tax-deferred, meaning the growth gets taxed later. And that's fine. It's just not the goal. The goal is the Roth IRA, because that's where the growth is tax-free, provided you have the account for 5 years and you've reached the age of 59 and a half. So the second half of the move is the rollover. So many plans let you take what's called an in-service distribution of those after-tax dollars, even while you're still working, hence the term in-service, and roll them into a Roth IRA. We look at doing that every year for clients who are eligible. That way, the money spends as little time as possible in a tax later bucket, and more importantly, as much time as possible in the never taxed again bucket.
And quite honestly, it doesn't make a lot of sense. It's quite illogical that the rules work this way. For the government to allow you to take these after-tax contributions while you're still working and roll them straight into an account where they grow tax-free. It just doesn't make any sense. It's so illogical that most people assume it can't be real. That's probably half the reason nobody's ever heard of it.
So now you might be thinking, this is one of those strategies that sounds great on YouTube and then really turns out to be for someone else, someone with a private banker and a family compound.
I think it's actually the opposite. These plans live inside an ordinary workplace 401k. Larger employers are more likely to offer it, such things like Fortune 500 companies often have them built in, but more plans are adding it every day. The people using it are executives, highly paid salespeople, engineers, physicians, attorneys, and business owners, usually with well-designed plans. Now, it's high earners with a regular paycheck that are taking advantage of these, which is exactly why it's probably never come up in a conversation with you.
So we'll be straight with you. Though this isn't for everyone, and we'd rather tell you that now than let you chase it, if your plan doesn't allow after-tax contributions, this door is just flat out closed and no strategy opens it up. And if you're not already in a position to save beyond the regular 401k max, this isn't your next move. You'd be solving a problem you don't yet have. It's built for one specific situation where you're already maxing out, you're saving more on top of that, and your plan has the room.
But if that's you, understand what's actually at stake here. This isn't about chasing another investment fad. It's about tax diversification, building more tax-free income for retirement, and lowering your lifetime income tax bill. And hopefully that would give you decades of flexibility years from now, both for you and your family. The more money you move into tax-free accounts earlier in life, the more options you have later. And this particular room, don't forget, expires every year if you don't use it. So planning, there's some urgency to it.
So here's the one thing to do this week. Ask your HR department or your plan administrator 2 questions. 1, does the plan allow after-tax contributions above the regular limit? And 2, does it allow in-service distributions or in-service Roth rollovers of those dollars? That's it. 2 questions, 1 email. Take a screenshot so they're still on your phone when you sit down to write it. So if the answer comes back yes, you've just found a room most people at your company don't know even exists.
The best planning opportunities are almost always the one nobody mentions, and asking the right questions is how you find them. One more thing. If someone you work with is maxing out right alongside you, send them this video. Same plan, same hidden room, and odds are nobody's told them either. Now, you just learned about one door into a Roth, but that door only opens if your employer built it in. And if you've ever been told you make too much money for a Roth, you were only told half the story. Here's the other half, and every door it opens. Watch it now. Because investing is the easy part.